When a C corporation distributes dividends to its shareholders, these payments are subject to taxation at both the corporate and individual levels, a situation commonly referred to as double taxation. Here's how this process works. Corporate taxation. The C corporation pays a federal corporate income tax on its profits at a flat rate of 21%. Individual taxation on dividends. After the corporation has paid its taxes, it may distribute some of its after-tax profits to shareholders in the form of dividends. Shareholders then report these dividends on their personal income tax returns. Tax rates on dividends, qualified dividends. These are dividends paid by US corporations or qualifying foreign entities and meet specific IRS criteria. Qualified dividends are taxed at the long-term capital gains tax rates, which are 0%, 15% or 20% depending on the shareholder's taxable income and filing status. Ordinary or non-qualified dividends. These dividends do not meet the criteria for qualified dividends and are taxed at the shareholder's ordinary income tax rates, which range from 10% to 37%. Example scenario. Suppose a C corporation earns a profit of $1 million. It pays 21% in federal corporate taxes, amounting to $210,000, leaving $790,000 in after-tax profits. If the corporation distributes $400,000 of this as dividends to its shareholders, each shareholder must report their portion of this dividend on their personal tax return. If a shareholder receives $10,000 in qualified dividends and they fall into the 15% capital gains tax bracket, they would owe $1,500 in taxes on this dividend income. The distinction between qualified dividends and ordinary dividends is critical when understanding the tax treatment of dividends from a C corporation. Here are the conditions and cases where dividends fall into each category. Qualified dividends, which receive preferred tax treatment, are taxed at the lower long-term capital gains tax rates of 0%, 15% or 20%, depending on your taxable income. For dividends to be classified as qualified, they must meet the following requirements. 1. Payment source. Paid by a U.S. corporation or a qualified foreign corporation, meaning a foreign corporation that trades on a U.S. stock exchange or is located in a country with a U.S. tax treaty. 2. Holding period. You must have held the stock for more than 60 days during the 121-day period that begins 60 days before the stock's ex-dividend date, which is the date on which you must own the stock to receive the dividend. 3. Non-excludable types. Certain dividends cannot qualify as qualified dividends even if paid by a U.S. corporation. These include dividends paid by tax-exempt entities and dividends from shares held in hedging transactions such as options or short sales. An example case: if you own stock in a publicly traded U.S. company like Apple and meet the holding period requirement, the dividends you receive are likely classified as qualified dividends and taxed at favorable rates. Ordinary dividends, which receive higher tax treatment, are taxed at ordinary income tax rates, ranging from 10% to 37%, depending on your taxable income. These dividends do not meet the criteria for being qualified. 1. Non-qualified payer, paid by foreign corporations that do not qualify, such as those not traded on a U.S. exchange or not in a treaty country, and tax-exempt organizations or REITs, which may pay non-qualified dividends depending on the nature of the income. 2. Lack of holding period compliance. If you do not meet the stock holding period requirement for qualified dividends, the dividends are considered ordinary. 3. Special cases. Dividends from pass-through entities such as S corporations and certain distributions from mutual funds or ETFs may be classified as ordinary if the underlying income is not eligible for preferential treatment. Additional considerations. High-income individuals may be subject to an additional 3.8% net investment income tax, or NIIT, on investment income including dividends if their modified adjusted gross income exceeds certain thresholds, $200,000 for single filers and $250,000 for married couples filing jointly. State taxes. Many states also tax dividend income, and the rates vary by state. It's important to note that tax laws can change, and individual circumstances vary. Therefore, consulting with a tax professional or referring to the latest IRS guidelines is advisable for personalized advice.